Thank you very much, and good morning. Thank you for the very kind introduction. There's quite a lot to talk about, so I'm just going to crack on. Gold has obviously had a very, very interesting ride through the first quarter or first third of the year. We've had a massive breakout, all-time highs, but lots of other things have been going on which would suggest that that's not really what you might have expected, perhaps if you could foresee changing expectations back in January, because interest rate expectations, which has been a big driver, of course, of asset markets, changed hugely. The US dollar, although it had a little bit of a dip, remained strong, but gold was helped by having tremendous demand, almost irrespective of the price. And there's just an idea of how we're going higher, and a couple of price targets for you. One very, very significant target higher and one not very significant target low, which might be good for those of you who are feeling FOMO and haven't jumped on yet. Now, let's look at changing expectations of interest rates, because this governs so much of what goes on in the world, not just in gold. This is market pricing of the expected interest rate changes from the beginning of the year to date, where beginning of the year price expectations, the markets were pricing in about 1.5% drop in US interest rates by December. They're now pricing about 45 basis points, which is actually less than 2 normal rate cuts. And in fact, just before the fairly dovish data and commentary by Jerome Powell last week, they're actually barely pricing in 1. And there's quite a lot of commentary which suggests that, the way the US economy is moving at the moment, 1 is perhaps all it needs, but that is obviously a dynamic thing. Importantly, what's going on is if you look at the previous scenario where expectations dropped more or less in a similar fashion, gold did what you would expect it to do, which is to go down. But if you look at what it's been doing this year, it's been going up. So there's a couple of things that, that's unexpected behavior, if you like. Now, let's just look at a couple of factors which I always consider fairly important with gold. The US dollar moving higher and held a sort of key technical support earlier in the year, and it's sort of semi-breaking out of key technical resistance now on the weekly Ichimoku cloud chart. Why do I expect the dollar to rise? Well, there's a couple of reasons. The US is doing extremely well. I expect the yield gap to remain in place. The yield gap has been trending higher, and as it trends higher, the dollar trends with it. I'll show you that in a moment. Then, of course, there's relatively what are other currencies like. Euro is somewhat more vulnerable to energy issues, and also euro and emerging market currencies are vulnerable to a big export drive by PRC. And why is China relying on a big export drive? Because, it is a big exporting country, of course, but it faces weak internal demand, high rates of savings. So in order to hit, almost government-mandated growth targets, it must swing even harder to the export channel. And that is going to be tough on some other currencies. But I think it'll be most tough on, say, euro and emerging market. Then finally, of course, the currency of the moment, very exciting, the Japanese yen. Now, the yen, I kind of expected the yen to strengthen after the BOJ sort of made its pivot away from yield curve control. But actually, I didn't consider, there's a lot of other things to consider, but the key thing to consider is the Ministry of Finance, which stands behind the BOJ, has 2 real choices, kind of choice of lesser of 2 evils, as one commentator put it very well. They can throw the yen under the bus, but they cannot throw the Japanese bond market under the bus. And so that's why the yen is still carrying on. From a technical point of view, last week's low in the yen, 161.61, was a pretty good low to bounce back from, and the BOJ did obviously engage in a lot of intervention then. But if you look at the fundamentals, there's no reason to suspect that the yen can't actually weaken further. And circling back to the dollar, that is part of the stronger dollar narrative. Lastly, there's your yield gap. You can see it's widening and the dollar is increasing. And lastly, there's a very long-term cycle in the broad dollar index. It bottomed out quite recently, and I expect that to be a tailwind for the dollar. So why am I saying all of this? It's so that you can see that if the plus story or positive story for gold weakens, there are actually some quite serious tailwinds out there. What this rally is not about, as far as I can see, is concern over inflation, because US inflation remains pretty well anchored. And although it's not going down as far as the Fed would like, it still remains nonetheless quite well anchored in the medium term, and the gold price has sort of detached itself from that. So let's look at the pluses. Central bank demand. Now, central bank demand in January and February, which is the last data I think I've got hold of, is about 58 metric tons. So it's going in the right direction. It's not great looking on one hand, partly because they're not totally insensitive to what's going on with the price and with real rates and so on. But if you look at it on a pro rata basis, it's kind of comparable to Q1 of 2022. 2022 turned out to be a really great year for official sector demand. So, you know, it could yet turn out that way. I don't feel I've got to run through all the reasons why central banks like to buy gold, because they're broadly the same reasons the private sector likes to buy gold. Asset with no liability, and good portfolio diversifier, it's liquid and so on and so forth. And of course, they're probably looking down track and seeing signs of greater bond issuance by both America and Japan and probably even China and so on. So they're looking at that bond supply picture and saying, yeah, we probably need a good diversification. So one thing I'll say, and before sort of talking about China and Chinese demand, is that just a little sort of sidetrack, is that when people think about gold buying by central banks, it's pretty natural to think of the People's Bank of China as its main kind of constituent. So everyone's kind of go-to gold buying central bank, and fair point. But it's worthwhile bearing in mind a couple of things, because there's a little bit of a blurry kind of notion around this. PBOC's reserves come to 4% of its, gold comes to 4% of its reserves. That's not a lot, and it doesn't tell me there's some wholesale pivot from, one currency to gold. The other thing is that US dollar is basically 58% of China's reserves, and it has been for the last decade, and it's not going down. And given their export drive, that's even less reason to expect it to go down. It's just a fundamental balance of payments issue. They are pivoting from US bonds towards agencies because there's high yield, but if you stack it all up, the one thing that, and I haven't put this number on here, but in defending the yuan, they might have spent about 25 or 30 billion US dollars so far this year. But given the context of an estimated $3 trillion of reserves, that's really not sort of doing very much. Now, China, let's go back. China, Chinese demand, largely, I think, driven as pretty naturally, if you like, pretty naturally, it's coming from people being concerned about weakening asset prices, both in the property sector and the equities market. Some of you might say, hey, but Chinese equities just bounced really well in the last month or so. Well, we know that Central Huijin, which is a Chinese state entity, is estimated to have spent 330 billion yuan, which is about 46 billion US dollars, propping up the stock market. So if you're looking at that from outside the stock market and you're thinking, where should I put my money? That's not a great signal, actually, because it's not like people like us coming in and saying, hey, this is value. This is a government agency coming in and saying, I don't care whether it's value, I need to buy it. So there's a lot of other concerns about regional bank capitalization and so on. And what's really interesting is that a lot of younger cohort of people are buying gold, particularly young women, actually. I was in Asia recently, and someone was doing an article on how young women are buying more gold as part of a kind of an independence, financial and social independence. But it's generally a young cohort, which sort of bodes well for the future. Now, let's put some numbers on that demand picture. Because the SGE had 522 metric tons of withdrawals in Q1 of this year. That's, I think, 30% bigger than Q1 of last year, so it's a real uplift in demand. People do focus a lot on China as being a massive buyer, and they are, but actually if you look at the gold futures and options combined, and I'm going to stress that word, options, because that is going to be the next part of my story. There's been some huge buying from the West in COMEX, and COMEX is only the visible part of the picture, so over-the-counter buying probably reflects a similar story where they don't report what sort of buying is being driven by optionality. Lastly, on the China sort of data stuff, that's March, by the way, that big red bar, which kind of fits in with where the price was going. A lot of people have been talking lately about the Shanghai Futures Exchange, which is super interesting, but actually I had a look at the net figures, and with the CME I look at the net figures as well, because you can't exclude the sellers. and the net figures, unless I've made a big mistake, are pretty so-so. So next time you see somebody saying, wow, Shanghai Futures Exchange, yeah, interesting, but they always seem to show you the buyers, they never show you the sellers. So bear that in mind. Now, the thing I was going to move on to, and I want to kind of try and explain this, hopefully in a way that's intelligible, basically, is there a missing factor in all of this demand picture? And you notice that I included futures and options demand, or driven demand, in my previous slide. Yeah, I think there's a really good, unlike the picture with the dollar, unlike the picture with real rates, unlike the picture with various other things, there's a really nice looking visual relationship here that you can pick up, which is the price of gold and the implied delta of gold optionality just on COMEX. And again, just to reiterate, this is just one part of the picture, but the OTC market, over-the-counter market, will probably be telling you the same measure if you could actually dig out all the information, which I can't. But, so I want you to think about, just hold a couple of ideas in your head. Why does this matter? Why would people buy gold? Because they've sold an option. The first thing I want you to sort of think in your head is that when you've sold an option, and the option's say at $2,500, and maybe the price is $2,300 now, and the price starts moving up towards that option strike, as it goes to the strike, it increases the probability of the option being exercised. And if you're short that option, you've got a risk of it being exercised against you. So you need to hedge that. And the way you hedge that is basically by buying the underlying, which is either spot gold or gold in futures if you've sold an option on the COMEX. That's the first thing. The second thing is this, is that most option market makers don't sell you an option. Let's say you buy, I don't know, 20,000 ounce option off them. They don't rush off and buy it off somebody else because the market is pretty fairly priced. They'll basically make $0. And also what they're doing is they're taking a view on volatility, rightly or wrongly. So what they do is they tend to naturally revert to saying, well, I will hedge this option exposure as part of a wider portfolio using spot, using futures. Okay? Now, if you put those two things together, what you can see is that very importantly, as the price rises towards and away from strikes, you'll get extra buying and selling generated. And that is a big part, I believe, of the story behind why gold rose so dramatically on top of physical buying and all the other sort of bullish factors. Now, so just to sort of finish up, because I know I've got about a minute or so left, I'm just showing you a price. That is not every single option that is available. That's just to make it simple for myself mainly. I divided it up into $25 increments. But you can see, well, the blue, that's the call options, right to buy, and the sort of orangey pink, whatever, is the puts, right to sell. And you can see where those things cluster, and they cluster around 2,400, 2,450, 2,500. So they were helping to generate some of that sort of buying interest as we went into February and March. Now, those are the open interest by month. You can see April has expired, but it was pretty substantial, and that helps explain part of that picture. May is big. Those smaller bars will get bigger as we move forward, and as traders and investors decide to buy into those upcoming months. So the thing I want to say about that is that if you want to sort of get a slightly more holistic image or picture of why gold is doing what it's doing, try and find out a little bit more about option expirations. You can look at the CME, and you can sort of scrape some of that data and just get like another leg to your understanding of the gold market. Now, I know I've got to get off the stage very soon and collect my chocolate, but this is just a final slide, which is just to remind you just how well gold is doing on an index basis versus that other famous risk-free asset, the US 10-year Treasury. Since 2021. Gold is doing extremely well. Do I expect it to continue doing extremely well? Yes, I do. It won't be a straight line, but I think the picture is fairly positive. Thank you very, very much.
Thank you for the introduction. And I like that healthy margins statement as well, because that's what this presentation's all about. I'm going to tell you now about what I hope to make and my vision to make this Australia's next new operating and producing gold mine. Location in the heart of Western Australia. There's a few things on that map that are important. I suppose it's one of the most sort of strategic areas of consolidation within the gold space at the moment. But importantly, in the heart of West Australian goldfields on one of the best gold fertile structures and excellent gold infrastructure and infrastructure around. We have a 1.8 million ounce deposit at the heart of that 1,000 square kilometre strategic land package. Strengths on that particular slide, very strong register with around sort of 50 to 60%, depending on how you classify this, institutional holding. Large North American shareholders and institutions as well, which really reflect the type of deposit or gold deposit that we have here. And that institutional register has only been strengthening. I suppose a very efficient discovery cost per ounce, which has really helped us keep a very tight share base and capital structure to the company, and a gold project at very respectable gold prices, which really puts the project value well above our current market cap and really, I think, speaks to the value in this particular stock. Apollo Hill, the first thing that makes it work as a gold deposit is it's one single, simple, large gold deposit in one single, simple pit shell. Low unit cost and very low processing cost and mining cost. And really what you're looking at there is essentially what I like to think of as a big blob of gold. If we look at that in cross-section, the economics on this deposit, which is, no getting away from it, low grade, but it's also very low margin, is an incredibly low strip ratio. So at only 1.5 to 1 life of mine, 1.2 in the first 2 years, and we deliberately pushed the strip ratio up to 1.2 because we're mining waste to help build our heap leach pad as a capital offset. If you think about mining on the pit floor there, those ore zones on any given bench, which are 10 metres high, would be 180 metres wide. And what that really translates to, again, is bigger mining equipment, lower unit costs, less geologists on the pit floor running around marking ore zones out, again, pushing that cost structure down. The other reason it works is probably the cleanest, simplest gold metallurgy that I've ever seen as a geologist over 26, 27 years. We're looking at gold grains, not nuggets, so they're easily liberated, easily digested by cyanide in quartz. And that's it. There's no carbon, there's no copper, there's no arsenic. Again, an incredibly low cost structure for this particular deposit. By crushing alone, to 8mm crush, which has been done as heap leach deposits elsewhere in the world, we see 75% or 78% in this instance in the test work, 75% discounted for our PEA studies, and a staggering 88% just by crushing. That's no grinding, no milling, no energy costs, or very low energy costs to get that gold out. We've done that test work across every rock type, every grade, and the other thing we see here in this deposit is, I suppose, consistency and delivery of that product on our heap leach pad. And what you see there at the end on that sort of tail is, irrespective of what rock or what grade we throw at it, we see a very predictable, clean finish, particularly within very respectable timeframes for a heap leach deposit of this kind. Our preliminary economic assessment, I think there we see in about 10 million tonnes per annum for 10 years, which delivers about 122,000 ounces per year, or 123. Very flat, simple grade curve and production curve. Again, simplicity driving that cost structure down. The heap leach circuit, I always like to make the point here that heap leach in Australia is not particularly common. Perhaps Newcrest, now Newmont's Telfer operations at Newcrest is one of the, probably the only operating heap leach in Australia. But in the world, about 54% of the world's gold production is done by heap leach. It's not new technology, it's not rocket science. And about the only thing we're doing here different is this high pressure grinding roll, which actually gives us about 14% extra recovery on our gold deposit, which is really what's brought this deposit into quite a new space. And high pressure grinding rolls are used at Tropicana, Newmont's Boddington. The cost curves on those machines and the maintenance and management of them are now very well understood. This is what I suppose our project will look like at full scale. The company that actually designed this for us built last year in Kalgoorlie a heap leach plant which was just commissioned last year exactly like this. So I suppose our cost structures and economics and capital costs on this, I like to think at this sort of initial scoping level for us are slap bang up to date and importantly local. So we've made a very well educated and informed study. And a capex cost there of about 304 million. I think some people have said that's a lot of money, but I've got to make the point that this is a 10 million tonne per annum plant. This is a very big mine. And the heap leach pads that we're looking at here are about 2.5 kilometres long, about the same size of the pit. I think about this time last year, I watched one of the Van Eck Exchange Traded Funds presentations, and the gentleman stood up and he talked about his all-in sustaining cost in his portfolio had been about 1,875. And I'm looking at our all-in sustaining costs from our studies, and if we've done our homework properly, I think I can say genuinely this is a lower cost operation, not ultra low cost or low cost, but a lower cost. And we can do that because of those economies of scale. That picture there is sort of 60, 70 tonne face shovel. Again, if we think about those operating costs, one gentleman sat in a digger moving the levers. Every time he moves that bucket, it takes him the same amount of time to move a bucket, whether it's 60, 70 tonnes or 10 tonnes. So again, pushing that cost structure down and increasing that margin. I suppose when we put this study out last year, we were really starting to see the economics make sense. We could see a positive net present value well above capex, really decent payback at about 2.8 years. But since that point, we have seen a sustained shift in that gold price. And I suppose it's worth pointing out today that probably even since I did this, I think the NPV of this project today would be about $1 billion. So if we see those strong gold prices moving forward, we are highly leveraged to those increases in gold price. That said, you know, I think we've definitely put a really good floor under that with those economics. The picture up there was taken last week from a light aeroplane. Again, this is this new project built by Zijin Norton Goldfields, 10 kilometres west of Kalgoorlie, showing that these things can be done. I suppose this, at the moment, is probably maybe about a tenth of the scale of what we're looking at with this project. So I think the enormity of Apollo Hill and that deposit that you first saw on that first slide is something to behold. And this is just the start of their 5 million tonne per operation when we're looking at a 10 million tonne per operation. That shows the sensitivity on those economic factors in terms of cash flow, internal rate of return at the moment, a very healthy sort of 55%. And I suppose that graph really speaks for itself. And I suppose one thing is, how is a junior company like ours with a sort of 55, 56 million market cap today going to get into production for a deposit that big when I need about $300 million capital? So, strategy of steps. The first step we're going to make is to do this pilot plant operation. So these pits here, these bulk sample pits, we're permitting, or we'll put the permits in for them in June this year, but we're finishing the engineering studies as we speak now towards that. There are about 1.2 million tonnes in there, which is 100th of the size of the big project or the main prize. It's actually done at a scale which is about 1/10 of the annual production. But 1 million tonnes is not a small operation in its own right. And we're looking at doing this for about a capital bill of $25 million, so well within reach. And those studies are really coming together. And that will produce about 24,000 ounces. So if you can do the maths there between the value of 24,000 ounces today, there's some really nice opportunities coming together. I think we've just had a presentation on options, particularly put options, or the ability to put a floor price under our gold sales at the moment for quite reasonable prices, which really start to de-risk this opportunity. And I think that has the ability to really make Saturn stand on its own feet and become a producer. So when I said this is Australia's next new operating gold mine, I mean it. I suppose we've still got to get to the big one. So the blue pit you see there is a step past that pilot plant phase, and that's sort of looking at a 3 to 5 million tonnes. There's a number of ways to do that, and we do have the benefit of some quite really nice contract crushing structures that have been tried and tested in Western Australia, particularly with these high pressure grinding rolls in the lithium space, where those contract crushers have really helped proponents or companies move to those intermediary steps to help them jump to that next one. So we're in sort of discussions and plans and really working on that concept at the moment to make the jump to that big one. And that blue pit's been done in a way that it maximises our opportunity to make that next step, not to necessarily pull out the best sort of MPV. The beauty of it is we'll be doing those red pits while we're finishing our PFS, which is in progress at the moment, and our definitive feasibility study that educates those studies and really de-risk the big project as well. We're not done. Exploration is open in every direction. There's some staggering sort of 10 metre at 10 gram intersections there to the north, but in every direction there on that map. A lot of ounces to add as we continue developing. We're there on the big project in terms of grade, strip ratio, scale, cost structure, recovery on a global scale. The rest of those bubbles outside the gold one on that deposit, on that graph, are in production already, so elsewhere in the world. We have a fantastic regional exploration package. We've just been granted the ability to explore on that main corridor right in the heart of that gold system, which is 40 kilometres long, 20 kilometres wide, with 16 prospects to date, some of which are starting to flow up. But I'm really excited about now being able to get onto these lake opportunities immediately along strike of that multi-million ounce deposit. That's our time to, I suppose, development, or our plan for development. You can see the permitting for the pilot going in June. We're working on our financing options as we speak. We're a long way through our pre-feasibility study and moving towards DFS on that big project and full-scale operations. And I suppose the concept is to really, once we have that pilot up and running, roll on, keep the PFS going, and really work hard on that regional exploration and perhaps find the next gem that transforms Apollo Hill again. And thank you very much for the opportunity to speak today.
Yeah, thank you everyone for joining us. Before we jump in the presentation, this is a picture of the open pit that we have at our Tarcoola project, so just useful to have in mind. Quite shallow, long, nice and tidy. Look, Ian's done a really good job explaining the merits of bulk open pit mining and the efficiencies of scale, both in capital and operating costs. So I'll focus a little bit on that, but also explaining why we really like South Australia. So we are gold only in South Australia. We really like South Australia because it's been a very long overlooked jurisdiction for gold development. So it's had two gold rushes in the late 1800s and the early 1900s. And as a state, it actually speaks for about 25% of all the known gold resources in Australia, but curiously represents only about 2.5% of annual production. And that really reflects about a 30-year tendency to be investing heavily in copper and uranium. When gold investment came back into vogue in the late 2000s, everybody kind of went back to muscle memory. They went back to the eastern margins of Queensland. They went back to Western Australia. What we looked at was a 130-year-old high-grade producing gold district in the center of South Australia, and we bought the district. So we've put together about 5,000 square kilometers of ground that comprises pretty much every significant historical exploration and production asset in the Central Gawler. We bought the only gold mill in the region, and rather than rush it back into smaller piecemeal operations, the objective was to step back, build up a much larger resources base, and focus on creating that large-scale bulk baseload mineralization, then focus on high-grade enhancements, and then focus on leveraging our existing infrastructure to be a 0 to 150,000 ounce per annum producer in a staged, lower cost, lower risk model. So that's something we've been working on pretty aggressively. We've had quite a bit of momentum lately. We've had 3 resource upgrades in the past 12 months. We have now put our Tunkillia project at 1.5 million ounces into scoping studies, and the drill rigs are now pointing at the high-grade targets in the neighboring goldfield. So a lot of momentum, a lot coming up for us, and we're very well capitalized to continue doing what we are doing. In terms of our capital structure, we've got about 218 million shares on issue, a pretty tight capital structure. We're in that sort of 60 million Australian dollar market cap range, around a $50 million or so enterprise value. And what we've seen over the past 18 months in particular is we have really focused on taking our sort of concept, our exploration concept, converting that into new gold zones, and then systematically converting those into new resources in progress, is I think a pretty strong market recognition of sort of the pace and quality of work. And we've really broken away both from the gold price and many of our, the production peers that we would aspire to be. So our chart there shows us against the gold price and VanEck's Junior Producers Index over the past 18 months. That's really been driven by a very strong consolidation of both institutional and retail investment around strong management alignment and strong performance. So board and management own just over 20% of the company, and about 75% of our register is board, institutional, corporate partners, and then proper real family offices that are very serious gold investors, and but for a license would themselves be considered some of the world's biggest gold investors. People for us, when we're thinking about capital, is really key. You can have a great asset and a bad team and it's going nowhere. We've really focused on building a team that has got a very diverse baseline of experience, exploring for permitting, developing, financing, operating, and optimizing major assets with a very strong pedigree, both in South Australia, where of course we are focused, and in gold. So some of you might notice we've got quite a few former Normandy and Newmont types here. We have people who specialize in building and optimizing mills. We have some very serious senior governance experience on our board. So we've built a company that is operating forward and is really designed to be the company that we want it to be. And that is to say, the company that we want it to be is a fairly significant gold producer. So our ambition is to turn this team and this platform into a 150,000 ounce per annum producer. We are focused on our Tarcoola and our Tunkillia projects in doing that, and we are focused on open pit mineralization. We like open pit because it's faster, easier, cheaper, and safer to explore for, develop, and operate. And our strategy with Tarcoola and Tunkillia has been to step back and build up regional geological models and then scale those out. So Tarcoola and Tunkillia together have around 3,000 square kilometers of ground between them, well over 100 kilometers of major structures. About 2% of those structures host about 1.5 million ounces already, so we think there's a lot of scale to be had here. But what we focused on doing, again, in that sort of 3-step strategy is to create that long-term baseline. That's our Tunkillia project. That's now 1.5 million ounces. And then focus on high-grade enhancements. That Tarcoola field, which is the home of South Australian gold and sort of from the 1893 gold discovery, that's a high-grade gold field that, as we now build up resources there, that can blend into a new large-scale operation at Tunkillia and obviously enhance the economics there. But it also gives us the opportunity to utilize our existing infrastructure. The Tarcoola project was processing through our mill in 2017 and 2018, so we have proven logistics, proven metallurgy, proven infrastructure, and we only need to build up a relatively small base of higher grade mineralization there to make the step from explorer developer into production with a very low capital cost and much, much lower risk in that transition. We can then operate that for 2 or 3 years and fund Tunkillia, the development thereof, as an expansion, as opposed to one big almighty jump. So it's very much a case of going from A to B to C to D to E in smaller, simpler, lower cost steps. And of course, we would propose that means lower dilution for our shareholders because we don't need as much money to start and execute that strategy, particularly if we're generating high profit ounces along the way. We really focused on this big bulk open pit concept in terms of bulk open pit because it works better than everything, everywhere, all the time, bar none. Australia tends to think of itself as a high-grade underground gold production jurisdiction, and indeed it is. But when you look around the world, and Ian's covered this a little bit, the vast majority of gold is produced from bulk, so-called low-grade open pits. And we actually profile Capricorn Metals here, and we not ashamedly refer to them as sort of our heroes in the industry. This is a team that has built 3 1-gram open pits into major producing operations: Mount Rawdon, Duketon at Regis, and now the Karlawinda project. And when we were looking at the Tunkillia project, we saw hints of what we saw in the early days of Karlawinda. This is an asset they bought as a 650,000 ounce asset. They grew it to 900,000 ounces and then 1.3 and 1.5 million ounces. It's now a 2.2 million ounce asset at 0.7 gram, but it is one of the lowest cost gold producers in Australia. So they've turned that into a scale production. They're running 4 to 4.5 million ton per annum through their mill. They're producing gold between $1,300 and $1,500 Australian per ounce for about 120,000 ounces of gold, and they're a $1.8 billion company. So the economies of scale are there. We bought Tunkillia just at the beginning of 2020 as a 550,000 ounce asset. We have then grown it to 900,000 and 1.1, 1.3, 1.5 million ounces. So we followed the same progression, and we've now shifted that into studies. This is what Tunkillia looks like on the ground. So this is our primary working area there. What we are is sitting on a large shear zone, and along the western margin of that shear zone, we've got 2 resource bodies that now together are about 1.5 million ounces. We have grown that 3 times on a very cost-efficient basis in the past 12 months. So it's been about $15 per ounce on an all-in basis. So drilling, assaying, field logistics, consultants, absolutely everything. It's very cost-efficient growth for us. That is an asset that is now going into scoping studies, and we think there's a lot of potential here. We have another 20 kilometers of strike along this shear zone that's never really been tested. When we think about what we're targeting in the scoping studies here, this is sort of a useful image to think about, or images to think about the geometry of the geology. So it's great we've got the resources, but how do you get them out of the ground? How efficiently you can do that? Where is the distribution of money in the ground, so to speak? There's sort of 3 key takeaways to have here, and I'll start this by saying that this mineralization keeps going to depth, but we cut off our resource modeling at 300 meters depth. We're far more interested in finding the next deposit along strike than we are drilling 500 meter deep drill holes for 1 gram mineralization. But within that 300 meter deep pit, we basically have 3 key features. One is a slight bias to shallow, so about 80% of the ounces are within 200 meters of surface. 2, right in the middle of that deposit, one of the first things we did was drill and confirm to ourselves the existence of a higher grade central zone. So there's a 300 meter long zone in the middle of that deposit, and you can see a cross section of it here on the slide. This is really instructive to think about how we might develop this. What you're looking at there in the primary mineralization, which is the sort of vertical sequence, is 80 to 100 meters of mining width, right? So that is big bulk open pit floor. It's the most efficient way you can mine anything. We're mining coal, but it's gold. So that's how you want to mine. But within that, in this central zone, you can see there's 2 sort of colors there, orange and red. We've got 20 to 30 meters of mineralization that has grades of 2 to 10 gram per ton in the mining blocks, or I should say in the mineral model. So there's also a concentration to the center of this deposit, and naturally you've got to start a bulk open pit somewhere. So that's a great place to do it. And then along the top of this, you've got that light blue sequence. This is 275,000 ounces of gold. It runs the full length of the deposit. So as you're doing your pre-strip for bulk open pit, that is paying you. So we're quite excited about that, and everything that we've looked at is just inside the little green box on the shear here. So there's a lot left to go. Hopefully, as we're developing and producing these ounces in 3 to 4 or 5 years' time, we're then looking out for where are we going to get the next 100,000 ounces and the next 100,000 ounces per annum of production. If you have a series of bulk open pits, you'd love to have some high-grade gold nearby, and that's where Tarcoola comes back into play. So we've now gone 70 kilometers to the north. Functionally, it's just a satellite of Tunkillia, and this is the home of high-grade gold in South Australia. So in 1893, this is where somebody was probably tripping back over from Kalgoorlie. They came across some outcropping quartz veins, and people spent the next 70 years mining gold out at 37 to 40 grams per ton there. Fast forward 100 years, and somebody put a pit around one of the shafts, and that's the pit you saw on the cover of the presentation. And that produced about 50,000 ounces at a bulk rate of 3 to 4 grams per ton. What we were curious about is what created all that shallow high grade. The pit itself is interesting. There's actually mineralization left in the pit floor. We've just drilled the pit floor to see if we cannot create some of that easy to grab in an existing pit mineralization that could go through our mill as a really easy stage 1, year 1. But what gets really interesting is when you look around that pit. In parallel with growing Tunkillia, we have spent the last few years mapping out what we think is the sort of subterranean architecture here. And what I mean by that is South Australia has the challenge in most respects of exploration undercover. What we have here now is a structural model, which is the first one that's been generated sort of comprehensively in the 130-year history of this gold field. And really for the first time, we can see all the known historical gold occurrences in a consistent structural framework. The 4 orange circles that you see on the slide here are the 4 locations in this 15-kilometer long field where mineralization outcrops. And everywhere it's outcropped, it's been scratched and dug. And everywhere it's been scratched and dug, it's had gold. Everywhere else, it goes undercover, and it might only have 1 or 2 or 3 or 4 meters of cover. But we think this presents a very interesting opportunity to create a field of high-grade discoveries and high-grade open pits to both blend into that neighboring Tunkillia operation, but then again to use as stage 1 feed for our existing mill and start this whole production and development cycle going with the restart of an existing mill instead of the construction of a new one. So we've just started drilling on that. We have done quite a bit in the past 12 months. We have quite a bit coming up in the next 12 months. We've done a couple of institutional placements following the success of our resource growth. We have sold gold. We have another $4.95 million worth of gold and concentrates that we will be selling shortly. A number of mineral resource upgrades, which we hope to follow with a few more this year. And of course, putting some real baseline economics around Tunkillia with the scoping studies will be a really important point for us to really step that forward as a development project and then start thinking about how we optimize instead of just prove our point. So we consider ourselves pretty unique as a platform on the market. We have a very strong platform. We have very strong growth. We've got great leadership. And we've got a very strong sort of development pathway. And of course, we're very well funded to keep doing that. So we expect to be delivering a lot of very interesting updates over the coming weeks, months, and years. And certainly happy to answer any questions if you have them at our booth. Thank you very much.
Thanks for having us. So yeah, at Australian Rare Earths, we are developing a portfolio of energy transition metals, and that currently consists of rare earth projects and a uranium project. Our flagship asset is the Coppermara Rare Earth Project in South Australia. Why are we excited about rare earths? Well, really, they are critical to the world's decarbonisation efforts, and the demand for the metal is set to grow over the coming decades with its use in electric vehicles, wind turbines, and defence applications. We also see the geopolitical tension that sits over the industry with China's virtual monopoly on the downstream processing of rare earth metals, raising concerns around security and sustainability of the metal. So the challenge here is to build a Western sustainable supply chain of rare earths, and in particular the heavy rare earths, dysprosium and terbium, which there are very few shovel-ready projects around the world that can come into production anytime soon. So this is really where AR3 is set to capitalise. So at Copper we've defined a significant resource and we still have plenty of exploration upside ahead of us. We've identified a sustainable development pathway via a heap leach approach, which will be a much lower capital and operating cost environment and also a lower technical risk to many of our peers. We believe that Copper now has a pathway to be one of the first ionic clay projects into production here in Australia. And to complement this, we're building out a strong exploration portfolio with other early stage projects that will provide AR3 with optionality, flexibility, scale and upside across the portfolio. Just a couple of key points on the corporate snapshot. We're really well funded. We have just over $9 million in cash, and that puts us in a really strong position to advance all of our projects in a meaningful way over the coming period. We've also got long-term shareholder support with Neo Performance Materials. And why Neo is important, they're one of the very few Western companies with downstream separation facilities and capacity outside of China. We have a MOU with Neo for offtake for stage 1 production at Copper and by having, I guess, access to their technical team working with our project development team, it certainly provides us great insights into developing a technical solution to produce rare earths that are going to go into the market and potentially to Neo. So just quickly on where our projects are, our flagship project, Copper is in the southeast of South Australia. We've also got some early stage rare earth exploration projects in North Queensland, and we've recently entered into an option to acquire the Overland Uranium Project in the Murray Basin of South Australia in what is a new potential uranium province. At each of our projects, we've got a really substantial land holding, which provides us lots of upside opportunities for greenfields exploration. So just a little more on Copper. We really believe that we've got the potential for a multi-generational asset here, providing magnet rare earths into the market for decades to come. The sheer size of the resource is significant. We have over 7,000 square kilometres of prospective tenure, much of it which is still to be drill tested. The setting of the deposit down in the southeast of South Australia is a little different to some of the ionic clay projects that you might see around the world, in that the clays sit over a shallow limestone base, typically less than 10 metres at depth, so very shallow, which means it's easy to drill, low cost and really quick to drill out. So we believe that there's significant upside in growth potential of the resource, given that the setting down in the southeast is very much lots of that clay over shallow limestone, given it is the limestone coast. So a little more on the resource potential. We've drilled just over 65,000 metres since 2021. We've defined a mineral resource of 186 million tonnes at just over 700 ppm TREO. The important thing to note there is that resource sits on only just 2% of the prospective tenure. So again, lots of potential for resource growth. We've also got an exploration target of 340 million tonnes to 3.1 billion tonnes, and that is also only on 20% of the prospective tenure. We drilled just over 8,000 metres at the end of last year. We've been releasing assay results as they've come in over the last few months, and what is really important to see there is we've been able to identify shallow, high-grade subsets of the mineralisation both in infill drilling but also in some extensional drilling to the north of the current resource. And why that's going to be important is because of the significant amount of tonnes we're going to have, the focus for the development team is really identifying those shallow, high-grade subsets of the resource that can come into production early. So all that drilling will go into a resource update in the third quarter of this year. I guess turning to the flow sheet and some exciting updates that we released last month. We've been conducting, over the last 5 months or so, a series of column tests, which are really the lab scale test work required to demonstrate your ability to produce via a heap leach approach. Our initial results have been really encouraging. We've had recoveries of rare earths in the range of 40 to 70%. Early days of this test work, and they are currently unoptimised. So the next round of test work will look at optimising the leach conditions, the ore preparation processes, how the agglomeration stage of the ore, and also ultimately how high we can produce from in those heaps, which all of those things will help us refine capital and operating cost in due course. I guess just quickly on cost, we believe that going to the heap leach will provide us the opportunity to come into production at a significantly lower capital cost and a much simpler technical solution and a lower technical risk than many of the other projects that you might see around. So we firmly believe that being a lower capital cost, lower technical risk will be a real strategic advantage as we move forward. Here's a conceptual layout of the project flow sheet at Coppermurra. As you can see, there is no drill and blast, no waste dumps, no tailings dams. There's a focus on recycling and water and reagents, so reducing operating costs. And there's also, it comes with a number of sustainability improvements in previous flow sheets. So here we're looking at a significantly lower water consumption, lower power consumption, and also the clays after going through this process are in a much better condition to handle for rehabilitation, for that rapid rehabilitation that we are looking to conduct. That rapid progressive rehabilitation in our planning, we are in farmland down in the southeast, so this is going to be really important. And what you see here in the photos is a trial pit that we conducted at Coppermurra. So we were able to demonstrate to the landowners how we could excavate the land, put the material back into the pits and rehabilitate those lands. It was an initial trial. We learned a lot from it. We'll feed that into our development plans, but it's one of the things I'm really passionate about this project. Opportunity to work really closely with the farmers on understanding what their soils look like today and what improvements can be made during mining and that rehabilitation process is something that the aspiration to leave the lands in a more resilient and productive state is something that we can be a legacy left and value left for farmers in the future. So next steps at Coppermurra is really focused on unlocking value as we advance to development. We have the majority of the baseline environmental studies already completed within the project area for stage one. And now that we have a flow sheet that we're being able to define, we believe that we can move into that mining lease application as one of the key next steps. We can be in production, as one of the first ionic clay production projects into production. So we've just recently added a uranium project into the portfolio, so pretty excited to bring that in. The Overland Uranium Project is a project that covers almost 3,000 square kilometres in the Murray Basin of South Australia. It's a prospective new uranium province As you can see on the map, it's about 200 kilometres south of Boss Energy's Honeymoon mine that's just gone into production. And we believe that the province has all the characteristics you would need to see for a sedimentary hosted uranium deposit that will be amenable to ISR production. So really looking forward on getting on the ground later this year and having our first pass at exploration test work. Just quickly on our North Queensland rare earth projects, we have two project areas in North Queensland which we believe are highly prospective for the traditional ionic clay style of mineralisation. The traditional style that you would normally see in China or South America, where you have that a much stronger tropical weathering profile, and we think that's the setting that we see here in North Queensland. So the two projects areas, first one's the Dalrymple project, the second is the Kennedy province, where we have a number of prospects there. We do like the area. We're encouraged by some early exploration work done by another company up in the area that's got some really encouraging rare earth mineralisation and some really encouraging initial metallurgical results. So once all of the exploration licences have been granted, we look forward to getting on the ground and rapidly assessing the prospectivity of the projects. So in summary, we think we've got a strategically valuable rare earth project at Coppermurra and can be one of the first ionic projects into production here in Australia. We've got the recent addition of uranium with the Overland project coming in and really leveraging our exploration team's extensive experience in uranium, and with a really strong financial position to advance all of the projects. We believe that we have AR3 in a position that has a bunch of optionality, scale and upside to deliver value for our shareholders. So thanks for having me. Thank you.
Thank you very much. Thank you. St. George Mining, let's go straight into it. Why St. George Mining? We think we've got a clear business strategy to create value for our shareholders. We're focused on future-facing metals. We think the market dynamics for clean energy sector are very, very strong. It's stronger for longer. There'll be bumps along the way, but we think it's a very good space to be in. Our focus is rare earths and lithium. We've already made discoveries of these metals and continuing to explore. And we've also got copper and nickel sulfide projects in earlier stage. We're in Western Australia, Tier 1 mining jurisdiction. That's our home base. Great jurisdiction, #1 hard rock lithium address. Also emerging for rare earths and particularly niobium. You all heard of WA1 Resources, probably spectacular success. We're not totally fixated with Western Australia. We'd also look at another Tier 1 jurisdiction, so we've always got a business development on the go. If we find a quality project in another high quality jurisdiction, we look at it. One thing that distinguishes St. George, I think, from a lot of the other junior exploration companies is our corporate support. So we have investment from some of the global battery players. They've given us money, and I'm sure they'll give us more to keep us going. Shanghai Jason is the #1 in cathode precursor materials in the world. China-based, but private billionaire runs that company. Amperex Technology Limited is owned by TDK Corporation of Japan, and they make more lithium-ion batteries than anyone else in the world. They probably make the battery in your smartphone or laptop or iPad. And Sunwoda Electronic, another China company, again owned by a private billionaire, a very significant lithium-ion battery maker. Some of you will recognise that chart there. It's the Lassonde curve. Pierre Lassonde, who built Franco-Nevada into a $30 billion or so royalty company, tried to predict the life cycle of a mineral discovery. So you'll see at the bottom here, you've got basically moose pasture and low value. And as you continue the exploration, you get a bit more value. And it's here where you've got a few sniffs that the value really starts to rise, and you've got a discovery, and that's a really fast value creation for the mining company, exploration company. So where is St. George? We're about here. We've got a couple of sniffs, and hopefully we're going to continue on the discovery curve and create a lot of value for our shareholders. So it's a good time to be having a good look at St. George. One person who's done that is Barry Fitzgerald. You probably know him as an award-winning journalist. Just last month, he named St. George as one of 3 junior miners to watch in the lithium as the lithium price recovered. Thank you, Barry. So our projects in WA, rare earths, that's our Destiny project. It's more Coolgardie region over here. The yellow labels, by the way, are all established lithium mines or deposits. Our projects are the red labels. It just shows you that we've got projects in fairly well-established mining regions. The lithium projects, someone else called this area to the south Super Lithium Province, so I'll take that. That's because it's got several producing spodumene mines and also some lithium deposits in development, so another very good address to be in. We have a large land holding, over 3,000 square kilometres of granted tenure and some more in application. So the Destiny project is where we've made our high-grade clay-hosted discovery, up to 5,125 ppm, total rare earth oxide, so that's a very good grade for clay-hosted. We've established that mineralisation across a 10-kilometre strike, and we've got 70 kilometres of prospective stratigraphy still to test. The high-grade mineralisation is up to 42 metres thick, and we've seen mineralised intercepts up to 100 metres. So that speaks to potential volume. It's quite significant. And there is certainly some high-value magnetic rare earths there. About 20% is the high-value stuff needed for the clean energy solutions. Next steps are to continue the drilling, continue exploration and resource definition, and also to do the metallurgical test work to make sure we can commercialise this. In addition to the clay-hosted rare earths, we've now been investigating some very strong magnetic features, which on first pass look could be carbonatites, and we're very excited by carbonatites given the success that WA1 Resources has been having. We did a gravity survey over these magnetic features, and 4 of them came up with gravity highs. We announced this just yesterday, so feel free to have a look at the announcement for more detail. We're near the Ida fault, which is a big crustal fault. It's the kind of conduit for these intrusions to come up, so it's a very good geological setting. We think these could be either carbonatites, which will be prospective for niobium or rare earths, or late-stage mafic intrusions, which are prospective for nickel, copper, PGEs. So at least 2 of the targets are looking really similar to the carbonatites at Mount Weld and Looney. Again, we don't know for sure until we put some drill holes in there, but they're very, very exciting targets, and we can't wait to get out and drill them. Mount Alexander is our flagship lithium project. We're in the Mount Ida lithium province, where Delta Lithium has been the first to establish its resource here. So Delta Lithium, now Mineral Resources has bought in, got about an 18% stake, but it's become quite an active region. The pinky area is Gina Reinhardt Hancock prospecting, exploring with the Indian government, Legacy Iron. They just started drilling 2 weeks ago, so stand by and see what they discover. IGO's down here in a joint venture with Venus. So we've got some very big players concentrating on this area. We're still independent with our support from our corporate shareholders. We think we've got a similar geological setting to Delta. So Delta is here. The Copperfield granite here is what we think has mineralised the pegmatites. And we've got a similar contact greenstones with the Copperfield granite. That's where we think we might get a bigger discovery. We've got more than 500 pegmatites mapped already. And what we're using at the moment to target for lithium success is the potassium to rubidium ratio. We're going to announce this tomorrow, so I can't tell you too much more, but we've done a fairly big exercise of potassium and rubidium ratio mapping across the project and found some really high priority targets. We know that there's high-grade lithium in the system. We've drilled already and got up to 1.8% lithium oxide intervals aren't thick enough to get super excited, but we know that high-grade mineralisation exists near surface and also down to about 300 metres. Very exciting drill intercept was a 121 metre thick intercept of a pegmatite. It was not unfortunately highly mineralised, but it was fractionated. So the trick is to try and marry those two, marry the high grade and the thick pegmatite, and we're in business. That's what we're trying to do, and we'll have some new targets to announce tomorrow. And we'll be drilling those during the course of the second half of this year. Lithium Star is a new arm for St. George, which we established late last year with the support of Amprex Technology Limited. So they invested $3 million for a 10% stake in our subsidiary, Lithium Star. Lithium Star had acquired 7 discrete lithium projects in Western Australia, several of those near existing mines. And we're going to continue exploration there with the support of ATL, who are getting a 20% offtake if we ever find something and develop. One of our favourites is the Mauna Rocks project. That is to the north of the Mount Cattlin spodumene producing mine. So we've got about a 50-kilometre strike of what we think is the greenstone belt that hosts Mount Cattlin here. And it goes up here, and we've got all this tenure, all granted now. We completed an aeromagnetic survey, and it was very, very encouraging, the results. There's a late-stage granite intrusion there, quite big, 18 by 8 kilometres. Now that could be the source of mineralised pegmatites. So one box ticked. We do noticed more greenstone sequences, so another box ticked. And we've got some very strong structures and domain boundaries also, which are quite influential in the control of mineralisation. So we're ticking all the boxes there. We're just going to fine-tune drill targets and get going with some drilling there as well during the second half of this year. The Agena project is also in Western Australia. We pegged this ground after Chalice discovered the Julimar mineral deposit. We thought, is there anything else in the Western Yilgarn that's been overlooked? Everyone's been going into the Victoria Desert eastwards. Let's go back to the western margin of the Yilgarn and see if there's anything there. And we found this area near Geraldton, Northampton district. We call it the Agena project. There are historic lead, copper, zinc mines here. Basically, the old-timers found outcrop and managed to produce small amounts of metal. We found an area which was undercover, and the magnetic survey told us there were really strong magnetic features here, which could be associated with mineralisation. So we've got 20-kilometre-long interpreted intrusive complex. We think it's prospective for nickel-copper PGEs. We did our maiden drilling last year. We found lead and zinc. So that's positive because we know it's fertile and mineralised. Not what we really wanted to find, but we didn't drill the best target. The best target was wrapped up with some heritage arrangements, which have now been cleared. So we're going to go back and do at least one hole in through the centre of this magnetic anomaly and see if we can get that nickel-copper PGE deposit that we want. A quick corporate snapshot. Our share price has suffered as most junior companies have in the past few months, so a bit lower than where we'd like it to be, but we've still got plenty of cash to go and do this exploration, so we're in a sound position. Our key shareholders again, Shanghai Jason, our largest shareholder, Amprex Technology, supporting us with Lithium Star and Sunwoda. Our board, good corporate safe hands there, but the key to making a discovery is our technical team. So we have Julian Hanna on board as the General Manager of Growth and Development. Most of you would know his success at Western Areas and at Mod Resources. Charles Wilkinson, our Senior Technical Consultant, Chief Geologist level at Western Mining for nickel and also at Western Areas. And Dave Mahone, our younger, more robust geologist, who also worked with Charles at the Western Area. So a very capable team with a track record of success, and that's hopefully what we're going to be delivering more of soon. That's the presentation. We've got our team at the booth today, Julian, Charles and Dave, and as well as myself, so feel free to come and have a chat to us. We think we offer a discovery and growth opportunity across multiple projects. Thank you very much.
Good afternoon, everyone. Yes, I'm Nick Earn. I'm the Managing Director of Alkane Resources, which is a gold producer and explorer with most of our activity in the central west of New South Wales. So let me tell you a little, this is sort of the high-level bits of our company. The first bit is that we have a demonstrated record of producing, and we've been producing at Tomingley, our gold mine, since 2014. We have a track record of exploration. We've got over 50 years exploring in New South Wales, and many of the deposits that we talk of today, and that includes McPhillamys that we joint ventured with Newmont, have been discovered by our exploration team. So I'll talk a little bit about that because we have a lot of exploration results still coming. We've made different deals over the past to create shareholder value as well, and we have a very solid balance sheet as we go through a capital upgrade program at present, extending our mine life. So I'm going to dive into those things. First, to the recent highlights of our company, remembering that we are a producing miner. So in the last quarter, we had a disappointing quarter by our standards as we ramp up. I'll dive into that more. But we still consider ourselves on track for the lower end of our guidance of 60,000 ounces this year. We have released an updated reserve statement for our mine, and so the underground mine at Roswell, so we now have over 500,000 ounces in reserve there. And the plants that we're upgrading right now, spending money on, I'm going to tell you about, and they're progressing very well. And then we have this really big project, which is a large copper-gold porphyry, the Boda and Kaiser system, which I'll be telling you about. We put out a lot of results on that in the last little period. In fact, on the 29th of April, we just upgraded our Kaiser resource. These fine-looking fellows, of which I am numbered amongst one, is our board. Just draw your attention to Mr. Gandel, who is our chairman, but also the 18% shareholder. So here, when we talk about 20% directors and management, 18% of that is Mr. Gandel's share of the company. And I'll also draw you a little bit to our balance sheet at present. So we have cash and gold bullion of $35 million. We've drawn, of a $60 million facility, we've drawn in the $20 million, about $26 million worth of that. And that is not included in the cash balance. So, because this is the 30th of April, and this is the 31st of March. So logically, we have 26 plus 30 in current cash as if we stand right now. So first to Tomingley. Where are we? This is in between Dubbo and Parkes in the central west of New South Wales. Like I said, been operating since 2014. We have an existing mine up here, and then this is the Newell Highway. We have a whole series of tenements down the Newell Highway. And we have a very large resource base underneath that. So this is our active mine and where we're talking about at the moment. So we are currently spending a lot of money to develop this mine here at Roswell. So this is an underground drive that we have that goes for 2.5 kilometres from our existing underground workings, and this is all go. We have a mining front active here at present. This is our new mining area. This extends our mine life out to 2032 at a run rate nominally from this underground of 80,000 ounces, and then when we add the open cuts, moving us to over 100,000 ounces. So a lot of these things I certainly encourage you to come and talk to me about in the booth, because there's a fair bit to cover here at the moment. But all these different things are activities that we have underway. We have all the approvals and licences we need to extend the mine life, which will take it from 2014 to 2032, so that's an 18-year mine life overall at the time. We have an underground drive. We are mining here right now. We have a whole heap of other projects underway. We've got our debt set up with Macquarie to fund it, and then of course we'll look to ramp the open cut. This is a picture of our underground mine. So we have not yet mined this open cut. We have all these coming over after the 2.5 kilometres. We have these levels in place, and this is just the first stope that we've halfway through firing. We've fired the bottom of this. We're doing the top. That's just here in the ore body. This stope is at 5.2 grams per tonne. It contains about 5,000 ounces in it. We're mining that right now. And it's this higher grade that gives us our optimism in this quarter's production significantly ramping from last quarter and then coming in at the bottom end of our guidance. So a very, very exciting period for us. And over the next 6 months, we'll extend so that we have multiple levels that we're mining on at present. This is above that. So just here on the surface, we're building the paste plant under construction. That's the belt filter that you can see. So we're putting a paste plant in to maximise the ore recovery. We expect to commission that late in Q3, so September this year. This is a very active area. This is under our existing processing plant. So existing processing plant's up here. This is a crushing house. All through here is going in flotation cells and a grinding mill to increase the recovery from the mid-80s up to about 92%, again with our existing expansion. So this is all underway at present. This is what we've been spending our capital on. So if I just recap Tommingly before I get into being as successful explorers, if you look at our share price trend, we're at about 60 odd cents, which puts our market cap at about $380 million. A large part of our lower rise compared to other people is because our cash balance has been dropping. But if you do any degree of analysis at all, you'll see our cash balance has been dropping because we've been investing in the future of the company. If we look at our exploration, so this is where we are again in New South Wales. This is where we were just talking about with Tommingly. This is Boda Kaiser. It's out here, what we call the Northern Molong Porphyry Project. So, roughly 4.5 hours from Sydney. If you look at our discovery cost per ounce, it costs us less than $20 per resource ounce to discover this. And it's less than $4 per resource ounce to discover Boda because it's very large. If we look at the resource, and all this is of course available online, but you can see that in terms of ounces equivalent, we have nearly 15 million ounces contained in Boda and Kaiser resources. So that's 8.3 million ounces of gold, 1.5 million tonnes of copper. It's the largest discovery in New South Wales in the last decade, and as both copper and gold, it ranks in the top 20 resources within Australia on its own for either of those, and then in the top 10 if you combine the two into an ounce equivalent. It is, however, a lower grade deposit, and so when we talk about the development of this, people in Australia are less familiar with the mining of these type of porphyries. However, the best known examples, of course, are Cadia or North Parks, both different styles of porphyries. However, right now, we have just finished the costings. So we did metallurgical test work last year. We've just finished the costings of a plant that obviously looks a lot more complex than this, but in 5, 10 and 20 million tonne per annum feed rates. And we are now combining mine plans that I just showed you back on these pit shells. We're combining those into economics, which is forming a scoping study that we'll put out in about 4 weeks' time. So all that will come out in 4 weeks' time, where we will say, look, if we were to develop a 5 million tonne, a 10 or a 20 million tonne per annum feed rate, remembering it's such a massive resource it can support any of those scenarios, this is roughly what it cost in capital, this is roughly what it would make at a scoping study level, which is plus or minus 30%. That's really to give people an idea of the economics of this deposit and why we've been pursuing it so aggressively. To give you an idea, many of the other companies you will have seen have been exploring, but we've spent the better part of $50 million in exploration money over the last 4 years defining and expanding the size of this resource. And so what we're doing at the moment as well is we're doing baseline environmental studies as well. So of course you put out a scoping study and it says it's going to cost you X bucks, you're going to make Y bucks over X years. Well then of course you have to go and get it approved. And so the first thing to do to get something approved you have to do in New South Wales, 2 years of baseline environmental studies, all the consultation and engagement that goes with that, submit your EIS and then go through that process. Many of you will be familiar with the difficulties that has created for many companies. Here and others, people particularly point to Regis with McPhillamys. Remember, Regis has gone through all the New South Wales projects processes and has that approved. It's now waiting on a federal approval. So it's actually the federal government holding up that project at present. But we ourselves at Alkane, we had the Dubbo Zirconia project approved in 2015, which we then split into another company. We've had the Tomingley Gold Mine approved, and then we've had a complete new mine plan approved for Tomingley again. So we're not a babes in the woods in the approvals process, and we own a substantial amount of farmland which we've bought under all of our deposits, which includes farmland that we bought in and around Boda and Kaiser, though there will need to be more transactions done there to complete that. The only reason I'm pointing that out is to say that this is why we're doing the environmental baseline work. This is all part of doing a scoping study, and we know what we're doing. A little bit on other exploration, because we do spend money, continue to spend money on exploration. We have largely done a phase of what's next through these regions, and we're currently evaluating and collating those results at present. So expect over the next sort of 1 to 2 months, we'll be able to put out the summary of some of these other deposits in and around Boda and what they look like and where we think we're going next with those. So that's more news flow coming for the company. And then regionally, some of these other deposits, we look for McPhillamys lookalikes, we look for Boda lookalikes, and we look for Tomingley lookalikes here. And so a large part of these as well, we're also waiting on drill results to then put out the next stage of the company. And so what we'll be doing is in June we'll be putting out our 5-year look ahead plan for the gold mine, and then in late June, early July we'll be putting out an updated business plan, because we'll have the scoping study for Boda, we'll have the 5-year mine plan, and we'll be able to talk more about what these exploration projects are telling us as to where we put our exploration effort. So a lot going on for us, not the least managing and operating gold mine with 250 people working there and a large project capital spend. We're of course doing that, but also really putting the rocket under the scoping study and the extension of the mine life and expansion of throughput at Tomingley. And then a pretty obvious business plan around that. Basically it says, get it done. So that's me done, and I imagine all of you will now look to get lunch done. So thank you for your patience in listening to me, and I hope you enjoy the conference. We're down at booth 90. Cheers.